Hi, and welcome back again to Tim Bigham's Big Time Options. We'll be taking a look today at a vol capture trade on South Korea iShare Fund EWY, where some huge option volume and a huge spike in implied volatility as fears out of the Iran conflict certainly manifest themselves in the South Korean market, especially. So, we'll take a look at a strangle and iron condor comparative from the last time it was trading at this price until now. So let's jump in and take a look, shall we? First of all, here's the scanner going back, as we can see from yesterday, over 365,000 contracts traded on the EWY, the South Korea ETF, versus less than 35,000 normal volume. So more than 10 times the volume. And now the IV is at the highest level over the past year. You can see the stock did find a little bit of footing here, going up 1.5% the previous day, one of the biggest drops we've seen in the South Korean market. And that manifested itself, this volume, in the implied volatility. Here's the 60-day IV as a comparative, right? By far the highest level over the past 12 months. You can see that huge spike based on that big volume we saw, putting option prices at the highest level we've seen by far over the past 12 months. You can see from Monday till Tuesday and then Wednesday's close, right? They had huge jump in IV as IV just continues to pop here, now over 76 using a kind of average sort of IV on the shorter term options. Not too long ago, it was trading under 50. Even yesterday and the day before, right, we saw that huge pickup in IV. That means option prices are more expensive. You can see it manifested itself across the entire vol structure, except at the very long end, and these are a little too illiquid, in my opinion, to trade properly. You can also see here is a 2-year chart of basically a 60-day, slightly out of the money 40 delta call. You can see the massive run up in IV, so we're more than happy to sell this here, hedge it off by selling some comparatively very expensive puts. Here's a shorter breakdown of it, a 6-month IV chart of that same 40 delta 60-day call. So certainly IV has absolutely gone parabolic here. We look for a pullback here, which will kind of temper the IV, right? Bring down option prices and do it in a somewhat neutral fashion. So, a couple trade ideas that I think certainly we're considering, right? Here is the simple sell strangle, right? Going out to the April option. So, went back to February 20th. Last time stock was around the price it closed at yesterday. Closed at 135.21 on February 20th, selling the April 100 put, 170 call. Could have gotten $2.30. You'd be selling about a 55 IV and about a 45 IV on the call side. So roughly about a 50 IV average weighting on that. And you'd have about 35 points cushion on either side, right? So certainly a very nice cushion on the trade. Fast forward to yesterday's close, we can see the EWY closed at 134.37, so down just slightly from our kind of comparative date back in February, right? But you can see that that same sell strangle, right, closed at $5.60 when we looked at the kind of benchmark going back to February 20th at a similar stock price. It only closed at $2.30, so up over $3, 3.30 to be exact. Why? Because that huge volume and huge jump in IV, which is now basically pretty much doubled almost, as the IV on the puts over 82, the calls basically at 70. So that sets up for a potential sell strangle. So did the comparative here, you can see from February 20th, right, that April 170 call, 170 or 100 put sell strangle would have been priced at $2.30. The stock at 135.21. So 35 points roughly of cushion, right? Days to expiration 56. The IV back then at around 50, right? Fast forward to yesterday's close, the stock basically at the same price. It dropped a little bit, 84 cents, but the strangle jumped $3.30, so more than doubled in price, even with 13 days passing, right? Normally, time decay would hit in, right? Shorter term options trade at a much lower price than longer term options, but the jump in implied volatility of basically 50% more than outweighed any benefit of time decay. So we see the basically the stock going nowhere in a couple weeks, right, or the ETF, but that sell strangle more than doubling, right, simply because of the nervousness, the huge jump in IV, this big run up in implied volatility, right, which we expect at some point to temper. We have plenty of cushion on the trade, as we said, 35 points to both the upside and downside roughly on the trade. So the stock can certainly move up and down in a big way. Taking a look at the chart here, I kind of put here's the 170 level, here's the 100 level. We're smack dab in the middle, so we have plenty of cushion on both sides. Here you see that huge sell off. The stock or ETF certainly had gotten overbought, had a massive pullback, right? Now we're getting to oversold levels, so expect it probably to kind of chop around here. IV to slowly come in, and here you can see the generalized IV at by far the highest level over the past year, so sets up ideally for some selling option strategies. And for those who don't want to maybe do a naked option, even though you have plenty of cushion, right, to take advantage of it, you can look at doing the iron condor. So did the same sort of comparative. So in this case, I took a look at the 105 100 put spread, the 165 170 call spread in iron condor, selling both back on February 20th. That was priced at just a little over a buck at 107 and a half. IV at that roughly, as we said, right around 50. Fast forward to yesterday, taking a look. Now I'm looking at 5 points further out of the money. So the 170, 175 call spread versus selling the 165, 170. So you got 5 points more upside cushion. And then the 95, 100 was our new one, right? Compared to the previous one, the 105, 100. So 5 points of cushion to the downside. But the iron condor actually trading 20 cents higher. So even though you have 5 points more cushion to either side, that iron condor 20 cents higher, and even though you have 13 days less time, right, that iron condor higher. So it's unusual that you see a spread that's further away from the money with less time to expiration trading at a higher price than a similar trade that was closer to the money with more time to expiration. Why? Because we saw that huge jump in IV, right? That huge spike, all based on this massive option volume coming in here. So we look for that to temper, take the trade off, and move on. So hopefully, it's kind of the impetus and the kernel behind our thinking here at big time options, where we look to find the edge, and then in the case of the iron condor, especially put on the hedge. But as we always say, trading is all about probability, not certainty. So make sure that you position size accordingly and make sure you exit when appropriate. So until next time, as always, here's the good trade.